Florida's governor isn't just under pressure. He's facing a statewide housing crash that's spiraling out of control. Right now, 15% of Florida home sales collapse before closing, and in some cities, it's as high as 1 in 5. Median home prices have plunged by $55,000 in a single year, while insurance premiums shatter records, topping $7,500 on average and wrecking nearly 18,000 deals. Double or triple the inventory, mass price cuts, and a tidal wave of failed contracts have left officials and families reeling. But what triggered Florida's rapid meltdown? And how did it get so bad that even the governor seems to have lost his grip? The answer is far more explosive than anyone expected. On a quiet street in Orlando, a young couple stands outside their would-be home, keys never handed over. Their story is becoming all too common. They cleared every hurdle: credit checks, loan approval, a flawless inspection. Then watched the deal disintegrate in the final days. The reason wasn't a missed payment or a change of heart. It was a sudden email from their insurance broker. The premium, once quoted at $4,800, had soared to $11,000. The lender refused to close. Months of searching, thousands spent on appraisals and inspections, all lost in a single afternoon. Across Florida, deals are unraveling at a pace that stuns even veteran realtors. In June, nearly 15% of home sales statewide failed to close, more than double the national average. In Orlando, Jacksonville, and Fort Lauderdale, the odds are even worse. 1 in 5 contracts collapses before the finish line, leaving buyers and sellers scrambling to pick up the pieces. MLS records for 2024 show a trail of abandoned deals, with more than 18,000 sales canceled in the past year due to insurance alone. Each failed contract represents a family forced back into the search, a seller left to relist, and a community rocked by uncertainty. Mortgage officers describe a market where last-minute surprises are the norm. Lenders now demand ironclad proof of insurance before releasing funds, but in Florida, that proof can vanish overnight. Insurance binders, once a routine part of closing, are now subject to sudden review. Carriers, facing mounting losses and rising reinsurance costs, reprice or revoke coverage days before closing. For buyers, the shock comes late. A premium that once fit the budget balloons by thousands, or the property is declared uninsurable altogether. The numbers tell a stark story. Title companies report that, compared to less than 1% in other states, up to 20% of Florida deals in some cities fall apart due to insurance. In Miami-Dade and Lee counties, the final premium often lands in buyers' inboxes just days before closing, sometimes 30% higher than the original quote. For families who have already paid for inspections, appraisals, and moving trucks, the financial and emotional toll is crushing. Beneath the headlines, the human fallout deepens. Some buyers walk away, unwilling to shoulder a $7,500 annual insurance bill or a condo fee that's suddenly doubled. Others fight to renegotiate, only to find lenders unmoved and sellers unwilling to wait. In neighborhoods where for sale signs linger for months, trust in the process is eroding. Each failed sale ripples outward, through families, agents, and entire communities, feeding a cycle of anxiety that no one, not even the governor, seems able to contain. By mid-2025, the numbers no longer whisper, they shout. Florida's statewide median home price has dropped to $390,000, a $55,000 slide from the prior year. In cities like Punta Gorda, the pain cuts even deeper. Values have fallen more than 14%, with median prices now hovering near $325,000. Naples, once a magnet for luxury buyers, has seen declines of nearly 20%. The pattern is clear. What was once a seller's paradise is now a battleground of price cuts and mounting anxiety. Inventory tells its own story. In Lee County, active listings have exploded from under 4,000 to more than 12,000 in just 2 years, a 200% increase, according to House Canary and Altos market data. The flood of supply isn't limited to one region. Across the state, single-family home inventory has surged over 37% in 2025 alone, with some metro areas reporting triple the number of available homes compared to the pandemic peak. For every house that fails to close, another sign goes up. For every canceled contract, another seller joins the growing ranks of the desperate. More than half of all listings now see at least one price cut before receiving an offer. Sellers who once envisioned bidding wars are slashing asking prices, sometimes by $25,000 or more, just to attract a showing. In Cape Coral and Fort Myers, market analysts note that over 50% of homes have undergone multiple reductions, with some properties lingering for months as buyers retreat to the sidelines. The glut is especially pronounced in newly built subdivisions, where unsold homes stand empty, their value eroding with every week that passes. Market analysts describe a feedback loop. Every failed deal adds to inventory. Every new listing puts pressure on prices, and every price cut feeds the sense of panic. Tim Weishire, president of Florida Realtors, points out that the speed of this reversal is unlike anything the state has seen since the last major downturn. He notes, Florida's housing market is finding its balance, but for many sellers, the floor keeps dropping. The fear isn't just about falling prices, it's about what comes next. In neighborhoods once buoyed by out-of-state demand, for sale signs now outnumber mailboxes. Investors who bought at the top are facing negative equity, unable to unload properties without taking a loss. Homeowners who plan to cash out and retire are watching their nest eggs shrink by the month. The oversupply is no longer a distant threat. It's visible on every block, in every city, and it's rewriting the rules of Florida real estate. As the supply glut grows, the market's fragility becomes impossible to ignore. Sellers slash prices, buyers hesitate, and the gap between hope and reality widens. Underneath it all, a deeper current of fear runs through the industry, a recognition that each new listing, each unsold home, magnifies the risk for everyone still holding on. Insurance premiums have become the single greatest obstacle to home ownership in Florida. By the summer of 2025, the average annual premium for a single-family house has surged past $7,500, more than double the national average. In coastal counties, the numbers are even more staggering. Buyers in Lee, Collier, and Miami-Dade routinely face $10,000 to $16,000 bills just to secure basic coverage. Even inland cities like Orlando and Jacksonville now report averages above $4,000, making insurance a deal-breaker for thousands who once thought themselves immune to coastal risk. The problem isn't just sticker shock. Since 2018, more than 20 private insurers have either gone insolvent or pulled out of Florida altogether, leaving families scrambling for options. Each exit pushes more risk onto the few carriers that remain and into the overloaded arms of Citizens Property Insurance Corporation, the state's insurer of last resort. Citizens now carries over 1.4 million active policies, a record high that industry analysts warn is unsustainable if another major storm strikes. For many buyers, the nightmare begins in the final week before closing. Insurance binders, once a routine formality, are now subject to last-minute review. Brokers describe a wave of panicked calls as policies are repriced or revoked without warning. In Miami-Dade, it's not unusual for a family to see their quoted premium double, jumping from $5,000 to $11,000, just days before settlement. The lender, facing new risk, pulls the plug. The deal dies. Months of searching and thousands in sunk costs vanish overnight. Mark Friedlander, an analyst with the Insurance Information Institute, puts it bluntly. Florida's insurance market isn't just broken, it's collapsing. We get calls every week from agents and families whose closings have imploded over sudden, outrageous quotes. The causes are layered. Repeated hurricane seasons have hammered insurers with billions in claims. Reinsurance, the insurance that protects the insurers, has doubled in cost since 2022, forcing carriers to pass the pain onto homeowners. Fraudulent claims, aging roofs, and stricter building codes all add to the calculation. But the end result is the same. Thousands of homes now labeled uninsurable, buyers blindsided at the closing table, and entire neighborhoods left in limbo. State regulators scramble to keep up. Emergency rule changes shorten the window for underwriting reviews, but the pace of carrier withdrawals outstrips any fix. Citizens, designed as a safety net, now teeters under the weight of policies it was never meant to carry. Internal documents warn of a potential death spiral if another catastrophic storm strikes before new capital arrives. For sellers, the insurance crisis means more than just lost deals. Properties that can't be insured become impossible to finance or sell. For buyers, every offer now comes with a silent question: will coverage exist at all? The fallout ripples outward, shaking confidence in the market and fueling a sense of dread that no one, realtor, lender, or regulator, can fully dispel. On the 15th floor of a Miami Beach condo tower, a retired school teacher scans a letter from her association board, a demand for $68,000, payable in 3 installments, to cover structural repairs and newly mandated reserves. For decades, Florida's condo owners could vote to waive reserve funding, patching problems only when urgent. That changed after the Surfside tragedy. Under Senate Bill 4D and Senate Bill 154, every condo over 3 stories now faces a legal clock. Commission a structural integrity reserve study, fund every dollar of projected repairs, and submit to milestone inspections by licensed engineers. Buildings older than 30 years must comply by year's end or risk being flagged as unsafe. The numbers are staggering. Reserve studies, now mandatory, often reveal decades of deferred maintenance. Concrete restoration, elevator upgrades, roof replacements, costs tally into the millions. Associations, forced to comply, have little choice but to levy special assessments. In Broward and Collier counties, owners report bills ranging from $20,000 to $80,000 per unit. For many retirees living on fixed incomes, the math doesn't work. Monthly dues, once manageable, have doubled or tripled. Some buildings have seen fees jump from $400 to over $1,200 per month in less than a year. The pressure is relentless. Owners who can't pay risk liens, foreclosure, or forced sale. Those who stay face a new kind of uncertainty. If the association fails to fund reserves or complete repairs, insurers may refuse coverage and lenders can call in mortgages. Units in non-compliant buildings become unsellable, trapping residents in a cycle of rising costs and falling values. Inside boardrooms, tempers flare. Lawsuits have erupted across Miami-Dade and Sarasota, with owners accusing boards of mismanagement, conflicts of interest, and rubber-stamping contracts with favored vendors. Court filings describe rushed reserve studies, opaque bidding processes, and emergency meetings where 5-figure assessments are approved with little debate. In some buildings, accusations of fraud and negligence are now as common as complaints about leaky roofs. For the retired teacher, the choice is stark: pay the assessment, sell at a loss, or risk losing the home she planned to age in. Her story is echoed in hundreds of buildings from West Palm to Naples. As the compliance deadline looms, entire communities are caught between legal mandates and financial reality. The promise of safety and long-term stability comes at a price that many never saw coming. The ripple effects stretch far beyond individual owners, threatening the viability of entire associations and exposing cracks in the foundation of Florida's condo market. Mortgage rates now hover just below 7%, a far cry from the 3% loans that powered Florida's last housing boom. The result is a monthly payment shock that few buyers are prepared to absorb. For a typical $400,000 home, principal and interest alone have jumped from $1,350 in 2021 to nearly $1,900 by the summer of 2025. That's a 40% leap in 4 years, before factoring in taxes, insurance, or condo fees. Layer on the extras, and the math grows punishing. Insurance premiums, already averaging $7,500 a year, add more than $600 to the monthly bill. In many communities, HOA dues and special assessments tack on another $400 to $900, especially in older condos now racing to meet new reserve mandates. For many buyers, the total outlay climbs to $2,600 or even $3,400 a month, well beyond the reach of most local paychecks. Inside a Jacksonville mortgage office, veteran loan officer Maria Alvarez scrolls through a week's worth of failed pre-approvals. She points to a pattern. Clients qualify on paper, but the numbers fall apart when insurance and fees come in. I've seen deals die over a $1,200 premium jump in the final week. Lenders, under pressure from regulators and investors, now demand hard proof of paid insurance and fully funded HOA reserves before greenlighting a loan. One missed document, one sudden fee hike, and the deal collapses. Maria describes buyers who started with optimism: young families, teachers, healthcare workers, only to watch them walk away, defeated by a payment that swells by hundreds overnight. The squeeze isn't limited to first-timers. Even buyers with strong credit and hefty down payments are running into appraisal gaps. In Tampa and Naples, contracts routinely come in $30,000 above appraised value. That means buyers must either cough up the difference in cash or renegotiate, often unsuccessfully. Sellers, desperate to close, cut prices or offer concessions, but the gap between what banks will lend and what homes are selling for keeps widening. For some, the only option is to back out and start over, adding to the mounting pile of failed contracts. Freddie Mac's rate history charts the climb in stark relief, from pandemic lows to a stubborn plateau near 7%. Each percentage point, mortgage experts say, slashes affordability by thousands a year. The cumulative effect is a market where even modest homes now require a six-figure income to comfortably afford. In Miami-Dade, a median-priced home with insurance and fees demands more than $90,000 a year in gross earnings, well above the county's median household income. As costs soar and approvals vanish, the pool of eligible buyers shrinks. The fallout is visible in empty open houses, slashed listings, and a growing sense that the dream of home ownership is slipping further out of reach for everyday Floridians. Institutional investors who once fueled Florida's housing boom are now heading for the exits. In quarterly earnings calls, major firms like Invitation Homes and Blackstone-affiliated funds cite risk models that no longer pencil out. Their filings show a sharp pivot. Instead of buying, they're offloading properties at a scale not seen since the last downturn. In 2025, investor-owned listings have doubled compared to the previous year, flooding the market with homes that once promised easy profit. For every new listing, the supply overhang grows, pushing prices down and leaving would-be sellers with fewer options. On the ground, the retreat is unmistakable. In Lee County, entire subdivisions stand half-finished. Rows of empty shells, framing exposed to the sun. Builders who once raced to keep up with demand are now slamming the brakes. Public records confirm dozens of projects paused or abandoned mid-construction, with developer updates citing market conditions and unprecedented insurance volatility as reasons for the stoppage. In Cape Coral and Naples, contractors describe job sites that emptied almost overnight. One foreman recalls his workforce shrinking from 120 to just 10 in a single week as funding dried up. The ripple effect is immediate. Hundreds of skilled laborers laid off, suppliers left with unpaid invoices, and local economies bracing for the fallout. The numbers are sobering. SEC filings reveal that major builders have cut new project starts by more than 40% statewide. In some neighborhoods, vacant homes outnumber occupied ones, and the hum of construction has been replaced by silence. Local governments, already facing shrinking tax revenues from falling home values, now contend with the blight of unfinished developments, overgrown lots, idle cranes, and mounting code enforcement complaints. Investor spokespersons, when pressed, point to a storm of factors: collapsing insurance markets, unpredictable special assessments, and rising mortgage rates that have priced out the very buyers they once counted on. Their strategy now is damage control, liquidate assets, minimize losses, and wait for signs of stability. For smaller landlords, the calculus is just as grim. Many who bought at the peak are now underwater, unable to cover costs as rents flatten and expenses soar. Some are forced to sell at a loss. Others simply walk away, leaving properties to join the ranks of the abandoned. The retreat of big money accelerates the oversupply. Every investor listing adds to the glut. Every stalled project deepens the sense of uncertainty. In city council meetings, officials express frustration at the pace of change, warning that the combination of job losses and vacant homes could erode the fabric of entire communities. As the professional players pull back, the burden falls on families, local businesses, and cash-strapped municipalities to pick up the pieces. The market's unraveling isn't just visible in the numbers. It's written across empty job sites and for sale signs that linger for months. The stage is set for the next epicenter of collapse, where the crisis will come into even sharper focus. Cape Coral stands out as one of the starkest examples of Florida's unraveling housing market. Once a poster child for rapid growth, the city now finds itself at the center of national attention for all the wrong reasons. Local market data shows inventory up 35% year over year, an influx that has flooded the city with listings and left sellers with few options but to slash prices. Median home values have dropped nearly 10% since last summer, erasing years of equity in a matter of months. For those who bought at the peak in 2022 or early 2023, the numbers are devastating. Many now owe more on their mortgages than their homes are worth. Negative equity, once a distant threat, is now a daily reality for families who thought they'd found stability. Inside City Hall, the sense of crisis is palpable. At a May emergency session, council members openly acknowledged the scale of the problem. One official, voice tight with frustration, described the city's situation as overwhelming, warning colleagues that the surge in abandoned developments and declining tax revenues was forcing a total rethink of the city's budget and services. Internal memos circulated among city staff paint a picture of mounting despair. Code enforcement can't keep up with complaints about vacant homes, while projections for property tax receipts have been slashed, threatening everything from road repairs to public safety funding. The city's own forecasts show a budget gap widening by the week as more properties slip into foreclosure or linger unsold. For homeowners, the collapse is more than a line on a spreadsheet. In neighborhoods once filled with moving vans and construction crews, streets now bristle with for sale signs. Some blocks have 3 or 4 listings per street, many with price tags that have been cut again and again. Families who moved in during the boom face a bitter choice: sell at a loss, try to ride out the storm, or risk foreclosure as insurance premiums and special assessments pile up. One resident, a nurse who bought her first home in early 2023, described feeling trapped. "We're underwater, we can't sell, we can't refinance, and every month the bills go up." The city's problems are compounded by a wave of unfinished subdivisions, rows of empty houses, construction paused indefinitely as builders pull back and investors flee. Local officials admit they underestimated how quickly the market would turn. Their emails, obtained through public records requests, reveal a scramble to address the fallout: emergency meetings with lenders, code enforcement sweeps of abandoned properties, and desperate calls to state agencies for relief funds. In the words of one council member, "The magnitude of abandoned developments and declining revenue is changing everything about what this city can do going forward." The pressure is mounting on every front. As inventory climbs and prices spiral downward, the city's leaders are left with few good options. The shock in Cape Coral is not just about numbers. It's about the visible, daily unraveling of a community that once seemed immune to downturns. For residents, officials, and business owners alike, the question now is not whether the market will recover, but how much more damage will be done before the bleeding stops. A press briefing at the state capitol draws a crowd of reporters, their questions sharp, frustration building in the air. The governor, usually composed, faces the cameras with a stack of economic projections in hand. His voice carries a rare edge. "We are dealing with a situation that's moving faster than any of our models predicted. The ripple effects are everywhere. This is not just a real estate problem anymore." Behind the podium, aides shuffle papers showing the fallout. Billions in lost home equity, a spike in property tax appeals, and a sharp drop in municipal revenue. The official tone is urgent. But the underlying message is clear: control is slipping away. Seller panic has become contagious. For weeks, realtors have watched as homeowners slash prices again and again, desperate to attract the shrinking pool of buyers who can still afford to close. Lenders and insurers, once silent partners in the process, now drive the conversation. Mortgage approvals stall over last-minute insurance denials. Insurers, battered by mounting claims and reinsurance hikes, refuse policies on thousands of homes, forcing buyers to walk or pay cash. The landscape of Florida's housing market has flipped. Scarcity has given way to a glut. In neighborhoods from Tampa to Palm Beach, for sale signs linger for months, and open houses draw more curious neighbors than serious offers. The only buyers left standing are those with cash in hand, often retirees or out-of-state investors willing to gamble on a bargain, immune to the constraints of lenders and insurance underwriters. For everyone else, the hurdles are too high. The consequences spill over into city budgets. Local governments dependent on property taxes face a growing shortfall as assessments tumble and appeals mount. In cities like Naples and Fort Lauderdale, officials warn of cuts to schools, fire departments, and public works. Code enforcement teams are stretched thin, fielding complaints about overgrown lots and half-finished construction sites. Some municipalities quietly prepare for layoffs and service reductions, bracing for a fiscal winter that could last years. Inside the governor's office, internal memos circulate with warnings about the pace of the downturn. One assessment, obtained through public records, admits that the crisis is outpacing any regulatory response. Proposals for insurance reform stall amid industry pushback, while calls for federal aid grow louder. Behind closed doors, officials debate whether the state can weather another major storm without a bailout for citizens. The insurer now carrying more than 1.4 million policies and facing exposure that dwarfs its reserves. The market's unraveling has left families, investors, and local leaders searching for answers. Failed contracts create a chain reaction. Each deal that falls apart adds to inventory, pushes prices lower, and deepens the sense of uncertainty. The governor's public frustration echoes a broader anxiety. As the crisis spreads, the question is no longer how to restore the old normal, but how much more Florida's communities can absorb before something breaks. In Florida, 15% of all home sales now collapse before closing, with cancellations driven by sudden insurance hikes, soaring homeowners association fees, and a statewide price drop of $55,000 over the past year. As over 18,000 deals were lost to insurance alone, inventory in places like Lee County tripled, and median prices in cities such as Punta Gorda fell by 14%. More than 20 insurers have left the state, forcing 1.4 million homeowners onto the last resort citizens plan. New condo laws have triggered assessments up to $80,000, pushing many owners toward default. Despite urgent press conferences and mounting legal battles, there is still no clear solution to the insurance crisis or affordability gap. How local governments and lenders will weather the ongoing fallout remains uncertain. What is clear, Florida's housing market, once defined by scarcity, now faces oversupply, rising costs, and a wave of instability with impacts rippling across families, investors, and the broader economy.